We're going to talk about the bond markets first up anyway. Leon, on Friday there was, I think, 3 billion plus rands worth of outflows from South Africa, almost all attributed to the bond market. But then I noticed almost the same came in yesterday. What's happening?
Yeah, look, I mean, I'm always cautious with how to interpret the data. The reality is that when you're busy with international transactions, there are timing lags often involved between when you book the trade and then also when the customers accept and things like that. So, you know, when you look at those types of flows, I tend to look at it over, you know, a few days, at least a 3-day period, which is a settlement period, to get a sense of what the overall flow is. And what the overall flow is telling us is that there has been inflows coming into South Africa, not massively robust. You know, we're on the 22nd day of the year, and we've seen round about 5 billion rands worth of inflows coming into the bond market. So, you know, there's still a little bit of appetite for South Africa, but it's not nearly as robust as it was in the first 3 quarters of 2012.
Has the bond index effect, in other words, us being included in a major bond index towards the end of last year, has that now sort of fizzled out a bit and now we focus on the fundamentals of the South African economy?
Yes and no. I mean, there's 2 ways to look at that. You know, the first point is that, you know, the original inflow that came in around September, October, that has come and gone. I don't think that is representative of the full investment universe or investor universe, you know, that potentially could come in. And I believe that in the medium term, there's still outlook for inflows into South Africa. In the shorter term, though, one needs to look at the cyclical events that have been taking place in South Africa. And unfortunately, you know, as you recall, just before the inclusion into the World Government Bond Index of City, we had the downgrade by Standard & Poor's, sorry, it was the Moody's. It was followed by the Standard & Poor's, and then in January followed by Fitch. You know, we've had political uncertainty and, you know, the strikes and the farm worker strikes now. You know, so the circumstances just simply aren't very conducive for huge amounts of money to flow into the country because the investor sentiment is just simply subdued. And this is despite the fact that South Africa within the WIGB continues to have by far the highest yield in the index. However, it doesn't have the highest risk characteristics. You know, so it's a country which you can add into your WIGB portfolio for an increase in your yield and a reduction in your risk. You know, as ironically as that sounds. But unfortunately, the local circumstances just aren't conducive for foreign investors to come rushing in gung-ho. I mean, lots of money has been going into emerging market funds around the world. It gives you an idea of you know, the investor sentiment and investor appetite towards emerging markets in general. Unfortunately, South Africa is just not you know, in the sweet spot.
No, it's not in the sweet spot at all. In fact, I'm just looking at the online version of the Business Day, bdlive.co.za, and the headline is "Unrest Downgrades Curtail Capital Inflows." And there's a very nice picture of you actually smiling away with a nice red tie on, but it's not a very smiley article by Mariam Issa. It says here, Labour unrest and rating agency downgrades have led to an abrupt slowdown of capital inflows into South Africa, which does not bode well for the weakening rand. Essentially saying what you've just been saying, but you must be worried about it. I mean, you don't put your name to these sort of articles without actually having some basis to it. How vulnerable are we? I think somebody quoted this morning on CNBC that there was 85 billion rands worth of inflows into the bond market last year, and if they decide to turn the taps off, how quickly do they have a propensity to do so?
Well, I mean, it could be quick. You know, the simple math is the following. If we're looking at, you know, current account deficit of 5.6%, now here I'm just using what is the consensus forecast, you know, as polled by Reuters, that amounts to about 185 billion rand that needs to be financed, right? That's a big lump of money. Now, you've already mentioned the 85 billion inflows that we saw last year. You've got to look at it, bonds and equities together. But it gives you immediately a sense of how much money needs to come in. Now, when you look at the previous year in 2011, we only had something like 20 billion rand that came into the country in both bonds and equities. Now, this shows you the challenge that we have in financing the deficit. Now, if we aren't able to finance that, what is the outcome? Well, it's simply a weaker currency, right? That's the simple outcome. Now, the central bank does not interfere with it. They're entirely happy to allow the currency to find its own level because they believe that the rand should be a reflection of underlying fundamentals. But, you know, we started talking about this at the end of last year. And unfortunately, the situation hasn't changed yet. What you're going to have to get to a point is where the rand is weak enough so that we can start to see the trade balance probably halve from its current level. Keep in mind that the trade balance is about half of the current account deficit. So of that 185 billion, about half of that roughly is trade, and you want to see the trade balance halve. I would argue something in that magnitude, and you're going to need a materially weaker currency to achieve that. We've had about a 10% currency weakness, but that is probably not enough. I wouldn't be surprised if the currency could weaken a further 5 or 10% in the coming months.
There's two camps here. There's the camp that is very much very vociferous at the moment, given what's happened with the Bank of Japan, saying don't use your currency as a weapon, because one man's currency gain is another country's currency loss. But you genuinely feel that we could, let's call it the 10%, the upper end. What is that? It's about that goes to about 960, 970, something like that. Do you think it's a fair level?
Yeah, look, I mean, 960, 970 is probably a little bit too much. I'm more comfortable in the 9.25, 9.5 type area where I would think the currency could stabilize. But keep in mind, we're not using it as an instrument. In South Africa's case, as opposed to in Japan, where there's a very deliberate attempt to intervene in the currency market, in South Africa the currency is an outcome, right? And the outcome here then is just simply that if we aren't able to finance the current account deficit, then it means that we are buying too many dollars, full stop, right? And your only outcome then is that your rand weakens. So it's not a case of, and you're 100% correct. I mean, you cannot, everybody cannot deflate their currency in order to grow growth, because then all currencies move exactly in tandem, right? It is absolutely, in that sense, a zero-sum game. But we are constrained by very particular challenges in our export sector. Keep in mind that 65% of our exports are commodity based, and we know that our mining sector is severely challenged at the moment. If you just take, for example, look at the ferrochrome industry, it's not such a big export for us, but it is nonetheless an important export. There have been numerous stories where ferrochrome industries have decided to buy into the Eskom demand management program, and they've closed down furnaces. This is lost production, this is lost exports, right? So if you can't increase your export side, then what you've got to do is you've got to see your import side decline. And how do you get that? Well, simply
Leon, very quickly, we've got about 30 seconds left. A lot of people would say there's absolutely no correlation between an efficient manufacturing export sector and weakness of currency, because people become lazy, and in fact a stronger currency means we become more efficient. Sorry, you've got to restrict you to 30 seconds on the answer to that one.
Look, you're 100% correct. I mean, a weaker currency is not the way to resolve productivity problems, and quite frankly, if you don't fix that, then it means that your currency will have to weaken in perpetuity. Education, those things are critically important to resolve these problems in the long term. In the short supply, and as I said earlier, rand is an output. It is not an instrument.